This is not a standard demand-driven rise in bank rate. The predominant cause of higher inflation is an extreme example of what economists describe as a terms of trade shock. Import prices, in particular those of energy and traded goods, have risen very significantly. This raises the cost of living for all of us and reduces real national income. We have not raised interest rates today because the economy is roaring away. The economy is only now back to the size it was immediately before the pandemic a couple of years ago. An increase in bank rate is necessary because it is unlikely that inflation will return to target without it. We face the risk that some of the higher imported inflation could become ingrained within the domestic economy, leading to a longer period of high inflation. Given the uncertainties, however, it should be no surprise that the exact size of the response was a close call in the deliberations of the Monetary Policy Committee. But we should also keep things in perspective. Today we have increased bank rate by 25 basis points to 0.5%. That is a change that will be felt by households and businesses around the country. But rates nevertheless remain very low by historical standards. The extent of any further tightening of monetary policy will depend on the medium-term prospects for inflation. The MPC judges that, if the economy develops broadly in line with the February report central projection, some further modest tightening of monetary policy is likely to be appropriate in the coming months. But it would be a mistake to extrapolate simplistically from what we have done today and assume that rates are now on an inevitable long march upwards. The pace and extent of any further monetary tightening will, as always, depend on how the economy evolves and on a number of developments which are highly uncertain. We face a trade-off between strong inflation and weakening growth. For example, domestic wage and cost pressures could continue to build, and the increase in import costs may not ease off as expected. Conversely, as illustrated in an alternative scenario in the report, developments in wholesale gas prices could cause inflation to fall below target in 2 and 3 years' time. There is therefore much uncertainty. The MPC will, it scarcely needs to be said by me, remain very vigilant.